Hi, today we're looking at the three most important charts for Friday, July 7th, 2023. And if you like this content, give it a like, subscribe, and you'll be notified whenever we put out a new video. So let's start with the S&P 500. Now, we talked about this chart here, very simple chart in today's morning trends piece. This is a weekly chart here showing a few things. Number one, that in the last 17 weeks since the March low, the S&P has been up 11 weeks and down 6, which shows consistency. And if you think about what an uptrend is, it's just really about consistent bullish action, right? We see that represented here on a weekly basis. We also see it on a daily basis. And so as of right now, the S&P could be down for the second time in the last 3 weeks. So last time we had a cluster like this was back in from April to May here, when the S&P was down 3 out of 4 weeks. Now, two things stand out. Number one, during this cluster here, S&P was still only down 22 basis points over this time, even though it was down 3 out of 4 weeks. Right now, down 2 out of 3, still up over 2%, because of course, in here, we had some big moves, especially last week to end June, right? And so that's given this uptrend, of course. And within the daily action, of course, uptrends are created by bullish patterns working, bearish patterns failing, daily moves that are lower than usual, and also a very small amount of 1% declines, all of which together, again, make uptrends. Now, as soon as some of those things start to fall apart, others will follow, and that's when something like this can change. But for now, this uptrend is still intact, and the market continues to show rotation enough to keep it like that. So changing gears here, talking about the 10-year yield. Now, coming into today, 10-year yield hit 4%, and coming into the non-farm payrolls number. And that was concerning, of course. But if you look at what's happened over the last number of months here since the report in November, we have some of these dates in blue and green. That just shows that after the report, or after the decision was made, the market, or the 10-year yield for this matter, was up within 3 weeks of it almost every time. It was flat in March. So even though we've been in a range here, the market has shown the ability to rally every time. And so think about what happened in June. First time we had a pause, right? What happened? Nothing for, well, a week or two, and then a big spike. And so that just tells us that the market is dictating what's going on here. Now, what has to change going forward is that we have to break this range, because even though we had some spikes, it really hasn't led to a full-on spike beyond what we've seen here, right? 4%, 4.2%. That's very important, because if you think about what the Fed looks for, of course, in terms of potentially changing what it wants to do, it says it's data dependent. Of course, that matters. Of course, we'll see when inflation comes through different reports, but sometimes those data points are in a lag. So what really is looking at, and it won't tell you that, of course, that is market dependent, meaning that it pays close attention to what the 10-year yield is doing. Sometimes it takes too long to do so, but eventually catches up. And we saw that first here in the end of 2018, 10-year yield topped. Took a while for the Fed to come in with the effective Fed funds rate eventually rolling over, and then of course catching up really quickly because of COVID. But even more so, you look about 2020, 10-year yield bottomed, started rising pretty aggressively through 2021 as we started to see commodities rise, as we started to see inflation come. But the Fed decided it was still considered transitory at that time. Then had to play catch up in a very aggressive way, of course, starting in the beginning of 2022, and then went on an historic pace of hiking, as we know. And so what happened now at the end of 2022? The Fed itself, the 10-year yield itself, started to pause. And it's really been in a pausing mode ever since then. And so, right, we have now the Fed saying the first time was going to raise rates, but not giving into the fact that it's done yet. And so what it's paid attention to, data, yes, but the market more so. If the 10-year yield here in red moves higher, moves above 4.2%, and goes higher from there, that tells us that the market, or the traders that are reflecting their views within the market, believe inflation is still with us, and they have to put rates higher. What's that going to tell the Fed? To do the same, and vice versa, right? If this spike to 4% doesn't hold and things start to roll over completely, and we get down below, say 3% or even more, you're going to see the Fed pause and then maybe cut sooner than they think they have to at this point. And so that's it for today. And if you like this content and want to see this full report and many others like it, please visit CappThesis.com and you'll be brought to this page. Well, you'll be able to see all the different reports that we offer to premium members, which include morning trends, last lick, postscript, and breaking out videos. And if you're an institutional investor, we offer, of course, the availability of bespoke work, one-on-one meetings, intraday commentary, and any special reports as well. Talk to you next time. Thank you.